Have you ever stopped to think about that one company? You know the one, it seems like they're involved in almost everything. From those blockbuster movies you stream to the tech inside your phone, maybe even the game console sitting under your TV. And yet, even though they're everywhere, figuring out how all those different parts actually, fit together and what it means for where they're headed, well, it can feel a bit like a puzzle. Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're diving deep into that fascinating global giant, Sony Group Corporation.
That's right. And we've been digging into a really comprehensive research report from Compasscope, plus looking at their latest business updates and some pretty critical industry dynamics. Our mission here is basically to pull out the most important bits, the key insights, so you can walk away with a much clearer picture of what makes Sony tick.
Okay, let's try and unpack this because it sounds like a sprawling empire. When you think Sony, what's the first thing that pops into your head? Is it PlayStation?
Probably for many people, yeah. Or maybe movies. Headphones?
Exactly. The Compasscope report really underlines just how incredibly wide their reach is. It's not just one or two things.
Not at all. Sony is, a truly diversified multinational conglomerate. They're delivering content, hardware, services across a whole range of industries. The report actually breaks them down into 7 core lines of business. 7. It really helps paint the picture of just how big this operation is.
7? Wow. Okay, lay them out for us.
All right. First up, the big one. Gaming and Network Services, or GNNS. That's your PlayStation hardware like the PS5, obviously, PlayStation Network, PS Plus subscriptions, the PS Store, and crucially, their own first-party game development, PlayStation Studios.
Got it. The gaming powerhouse. What's next?
Then there's music. This covers recorded music, music publishing, which is basically managing huge song catalogs and collecting royalties and revenue from streaming platforms like Spotify and Apple Music, plus licensing their music for movies, ads, that kind of thing.
Okay. And music's a big one, too.
Definitely. Then you've got pictures. That's their entertainment arm. Movie production, distribution through Sony Pictures Entertainment, TV shows, and a really significant presence in anime now, especially with Crunchyroll and Aniplex.
Anime, too. Interesting. What about the tech side?
Right. Next is Imaging and Sensing Solutions, or INSS. This is a highly specialized area. Think image sensors for smartphones, a huge market for them, but also for cars, like LiDAR sensors, industrial cameras, and components for digital cameras.
So the chips and sensors in lots of devices.
Exactly. Then there's what they call Entertainment Technology and Services, or ET&S. That's more the consumer electronics side. Digital cameras, high-end audio, those premium Bravia TVs, their Xperia smartphones. They also make professional gear for filmmakers.
Okay. Covering a lot of hardware there.
Yep. And then number 6 is financial services.
Yeah.
This is actually a pretty stable part of their business. Life insurance, non-life insurance, banking, wealth management. Mainly in Japan through Sony Life and Sony Bank.
Financial services. Didn't expect that one.
It's a significant, steady earner for them. And finally, number 7 is other ventures and emerging businesses. This is kind of a catch-all for things like medical equipment, R&D, exploring AI and robotics, and strategic investments in areas like semiconductor solutions and virtual production.
Phew. Okay. So boiling it all down, what does this mean for you listening? It means Sony isn't just, say, a gaming company or a movie studio. It's this complex web of powerful, interconnected businesses.
Precisely. And they often feed into each other, which is part of their strength.
Okay. Understanding all those different parts is one thing, but how do they actually perform? How do they stack up against the competition in these really tough markets? The Compasscope report gives us a good look here, right?
It does, and Sony holds pretty strong ground in several key areas. Let's start with gaming and network services. The PlayStation brand itself is a massive intangible asset. They've got exclusive first-party games, a really strong ecosystem. Think about the 123 million monthly active users on PlayStation Network. That's huge.
And things like backward compatibility help keep people locked in.
Absolutely. It keeps users sticky. Plus, PS Plus subscriptions drive that crucial recurring revenue.
Right. What about music?
Well, Sony Music Group is the second largest global music label. They've got this enormous catalog, over 2 million songs, especially after buying EMI. And what's really interesting, the report highlights that the operating margin in music is often around 19%.
19%? That sounds pretty high compared to, say, hardware.
It is. It shows how music acts as this consistently profitable, less capital-intensive engine for the whole group. It helps balance out the more volatile or investment-heavy parts of the business, It's a really important contributor.
That's a great insight. Okay, what about the sensor business? INSS.
Yeah, imaging and sensing solutions. Here, Sony is a global leader, an impressive 48% market share in image sensors. That's driven by their tech innovations and key long-term customers, like Apple.
Nearly half the market. So they're kind of the invisible tech backbone for a lot of phones and cameras.
You could definitely say that. It gives them this foundational power, even if most consumers don't realize it. And then in consumer electronics, they leverage that strong Sony brand recognition, particularly in high-end stuff like mirrorless cameras. That builds loyalty.
But it can't all be smooth sailing. No company avoids challenges. What headwinds does the report highlight for Sony?
No, definitely not smooth sailing everywhere. The report points out several big challenges. In gaming, for instance, game development costs are skyrocketing for those big AAA titles. And the competition from Xbox Game Pass and cloud gaming platforms is intense. It puts pressure on their revenue, their margins.
And relying so much on console sales could be a risk long term.
It potentially could be, yeah, if the market shifts dramatically towards cloud or subscriptions. Then in music, you've got the rise of independent artists and the sheer power of streaming platforms like Spotify. That challenges their traditional ways of making money.
Makes sense. What about imaging?
In imaging and sensing, Samsung is a strong number two. That creates price pressure. And Sony's heavy reliance on big smartphone customers like Apple, well, that carries risk too. What if Apple diversifies its suppliers?
Good point. And consumer electronics.
That market is just hyper-competitive. You've got giants like Samsung and LG with aggressive pricing, especially in TVs, that can really squeeze Sony's focus on the premium niche.
And there's the fact they're a Japanese company.
Exactly. That means significant foreign exchange exposure because they report in yen. A strong yen can really hurt their reported profits from overseas sales.
So putting it all together, how does Sony look compared directly to its biggest rivals?
Okay, let's break it down. Gaming. PlayStation dominates console sales, no question.
Yeah.
But Microsoft's Game Pass is a huge force in subscription gaming. Nintendo, they're kind of doing their own thing successfully in that family-friendly
Rich. Music.
music. Universal Music Group is generally seen as having the stronger overall catalog. But Sony definitely benefits from those internal synergies, using their music in their games and movies.
And the sensor tech.
Imaging and semiconductor. Sony leads on innovation, especially in high-end sensors. Samsung competes very fiercely on price, particularly in the mass market segments.
Lastly, consumer electronics.
Yeah, consumer electronics. Samsung and LG really dominate the mass market. That leaves Sony focusing on those premium niches, mirrorless cameras, high-end TVs, audio. They do well there, but it's a smaller piece of the pie overall.
Huh.
So, bottom line, Sony's advantages in gaming, music, and image sensors are strong, they're sustained. Their whole ecosystem approach creates recurring revenue and helps diversify risk. But you have peers like Microsoft innovating perhaps faster in cloud and subscription gaming, and Samsung just has that broader mass market reach. It's definitely a constant balancing act for Sony.
Okay, so given that really complex competitive picture, what's Sony's actual plan? How are they planning to grow, to innovate, to expand? What's the strategic playbook, according to Compassco?
It really boils down to expanding those recurring revenues and capturing growth from new tech across all those different but connected units. So in gaming and network services, the big focus is growing PS Plus subscriptions, using their first-party games to drive content sales and increase the average revenue per user, the ARPU, especially with premium games and these live service titles.
Like games designed to be played for years.
Exactly. They're also working to maintain that PS5 leadership while figuring out the long-term shift to cloud gaming. For music, it's about riding the streaming wave, buying up more music catalogs, and pushing their IP across different media games, films, etc.
And in imaging, more tech advances.
Yep, imaging and sensing. Enhancing the tech for better sensors, especially for flagship smartphones, but also pushing hard into other areas like automotive and industrial uses, trying to diversify beyond phones.
What about consumer electronics? Are they pulling back?
Not pulling back, but shifting focus. More towards those niche premium categories, cameras, high-end audio, moving away from the really competitive, low-margin stuff like basic TVs. They're also developing new gear for professional content creators.
And pictures, movies, and anime.
Pictures, expanding their offerings there. Blockbusters, sure, but also hitting hard with anime like Demon Slayer, developing IP across platforms, trying to get more revenue from streaming services and, of course, cinemas. And underpinning all this is their capital allocation. They're making strategic acquisitions, buying game studios, music rights, while also investing heavily in R&D, especially areas like image sensors where they need to stay ahead.
That definitely sounds like a comprehensive plan playing to their strengths. But, how achievable is it all? And what are the biggest risks they face trying to execute this?
Good question. The potential for revenue and profit looks high, particularly in gaming and entertainment, thanks to those recurring revenue models. Subscriptions, streaming, IP. Imaging sensors offer good mid to long-term potential, especially if they crack automotive and industrial, but it costs a lot to develop that tech.
So, capital intensive.
Very. Music and pictures, though, are highly scalable. Consumer electronics, probably more moderate growth, just in those premium segments.
And how likely are they to pull it off?
Well, the entertainment and gaming strategies seem pretty achievable. They've got the leadership, the IP, the ecosystem already. The imaging sensor side, though, that needs constant, expensive innovation, and they need to succeed in those non-smartphone markets. That's a big challenge. Consumer electronics, as we said, faces fierce competition and risks. Beyond the big economic factors like recessions or tariffs, we've got market risks like, what if cloud gaming really takes off faster than expected? And then there are execution risks. Just managing a company this complex is inherently risky.
Okay, and this leads us nicely into something really fascinating. The whole debate around the future of gaming console versus subscription versus PC, it's a huge discussion point, isn't it? And the Compasscope update apparently dives right into this, including Sony's latest thinking.
It does, and it's a critical area. The main takeaway from the analysis is that we're probably heading toward the hybrid future. Subscriptions like Game Pass will be important, yes, but likely additive, not replacements. The traditional model, buying consoles, buying games directly, that's expected to remain the main profit driver for the industry for, say, the next 5 to 10 years.
So Game Pass isn't killing the console just yet?
Doesn't look like it. I mean, look at the numbers. The PS5 has shipped, around 80 million units by mid-2025? That significantly outsells Xbox estimates. And PSN has 123 million monthly active users.
That's a massive user base.
It is. Now, Xbox Game Pass has an impressive 35 million plus subscribers, but Sony's actually stopped reporting PS Plus numbers regularly. They focus on that monthly active user figure instead, which tells its own story about engagement.
And their strategies are different too, right? Sony versus Microsoft.
Very different. Sony keeps saying no day one first-party games on PS Plus. They want to protect that premium game sale, which they see as a virtuous cycle. Microsoft, they put their big games on Game Pass day one. They've even raised prices to help pay for it.
And Microsoft is even putting games on PlayStation now.
Yeah, which is interesting. It shows they're exploring different models too. But even Microsoft admits Game Pass, while profitable, is maybe only 10–15% of their Xbox content revenue historically.
So why aren't all the big third-party publishers jumping onto subscriptions day one?
Economics,
Lois.
mostly. For their biggest frontline titles, putting them on subscription day one often just doesn't make financial sense compared to selling them at full price initially. They want to capture that high-value demand first. The fact both PS Plus and Game Pass have raised prices shows how expensive that day one content is to sustain in the subscription.
So scale still really matters for Sony's model.
Absolutely. That huge PS5 installed base and the massive PSN user count drive strong third-party sales at full price, plus all those microtransactions in ongoing games. That profit pool just keeps growing with every hit.
So the idea of gaming becoming like Netflix, the report says probably not.
The verdict is basically no. There are key differences. Gamers play far fewer different titles per month than people watch TV shows or movies. AAA game budgets are astronomical and need those premium sales, and Sony is actively not putting its biggest games on PS Plus day one. Even Microsoft's own projections suggest subscriptions won't be the majority revenue source.
Okay, what about PC gaming then? Steam versus PlayStation. Is Steam eating Sony's lunch?
The report frames it more as co-opetition. They serve slightly different markets or needs. Steam is great for price-conscious gamers, enthusiasts with its big sales and free multiplayer. But consoles, led by PlayStation, are actually forecast to grow faster in the near term, maybe 7% CAGR versus 2.6% for PC software.
Why is that?
Consoles offer that it just works simplicity, often a better performance for cost, and that huge integrated ecosystem. It appeals more to the mass market. Sony's using Steam strategically, releasing some older titles or live service games there to expand reach, but not abandoning its core console business at all.
That all makes a lot of sense. Okay, shifting gears slightly. What about Sony's actual recent performance? We've got updates from their Q1 earnings for fiscal year 25, right? How did they do?
They had a really strong start, actually. Overall sales for their continuing operations were up modestly, about 2% year on year, but operating income, that jumped to a remarkable 36%. Both were record highs for first quarter.
Wow, 36% jump in operating income is significant.
Really is. Net income was also up nicely, around 23%, and they felt confident enough to actually raise their full-year operating income forecast by 4%.
What about those U.S. tariffs we hear about? Any impact?
They actually revised the estimated impact down from potentially 100 billion yen to 70 billion. They put it down to smart inventory management and moving production locations faster than expected. They also mentioned that direct exports of their semiconductor parts to the U.S. are quite limited anyway.
Okay, good news for them there. How did gaming do specifically in Q1?
Gaming and network services saw sales up 8%, mostly driven by third-party software sales, so games made by other companies selling well on PlayStation. User engagement is still climbing, hitting that 123 million monthly active user mark in June, up 6% from last year. And the operating income for GNS, it more than doubled year on year, hitting a new quarterly record. Again, driven by third-party games and network services revenue, like PS Plus.
So subscriptions and other people's games are driving profit.
A big chunk of it, yeah. And their own live service games like MLB The Show, Destiny 2, Helldivers 2, they actually contributed over 40% of Sony's first-party software revenue in the quarter. That shows the shift towards ongoing games is working for them.
But wasn't there a delay? Marathon.
Yes, that's right. The big upcoming game marathon from Bungie has been postponed. They said it's to improve quality. Sony also confirmed they want Bungie to become more integrated into PlayStation Studios over time. And crucially, the report noted content and service revenue per user is growing faster than the number of users.
Ah, that's key. So each user is spending more on average. That's exactly what they want. What about music and pictures?
Both doing well. Music sales up 5%, driven by streaming, and catalog sales are increasingly important. The Demon Slayer movie was a massive hit in Japan, and they're rolling it out globally. In pictures, The Last of Us TV show got Emmy nominations, and an animated film, K-pop Demon Hunters, was apparently Netflix's most-watched original animated movie. They also announced a big new partnership with Bandai Namco, co-creating IP, collaborating on anime production and distribution, even using Sony tech in Bandai Namco venues.
Interesting tie-up. And the sensor business, INSS.
Also strong. Imaging and sensing sales were up 15%, and operating income surged 48%. Driven by more sensor shipments for phone and digital cameras, they're expecting future growth from bigger, higher-value sensors.
So tech is firing on cylinders. What about consumer electronics?
ET&S was the weaker spot. Sales decreased, mainly due to selling fewer TVs and currency effects. Aggressive competition in TVs was mentioned again, but their camera business within that segment did well.
And the financial services spinoff. Still happening.
Yep, still on track for September 29th, 2025. That segment's income was up slightly, but they lowered the full-year forecast a bit due to interest rate assumptions. The spinoff should let Sony focus more capital on its core entertainment and tech businesses.
Okay, looking at all these results, strong gaming income, solid music and sensors, but weaker TVs and a game delay. What does this tell us about Sony's execution? It seems like managing all this is incredibly complex.
It absolutely is. That diversified model is great for resilience. If one area struggles, others can pick up the slack. But it definitely increases the overall execution risk. It's a huge balancing act. The marathon delay highlights the challenges of developing these big, complex live service games. That's still a learning curve for them, integrating Bungie and building out that capability. However, the fact they're successfully increasing revenue per user in gaming, alongside the strong performance in music and sensors, it shows they can execute effectively in this incredibly complex environment. They seem to be learning and adapting.
All right, so for anyone trying to follow Sony's story, maybe considering investing, what are the absolute key things to watch going forward? What does the Contascope report flag as most important?
The report highlights 3 factors as having high importance. First, market position and competitive dynamics in gaming. Basically, can Sony keep its lead in console gaming as things shift towards cloud and subscriptions? How well they expand PSN services and succeed with live service games is critical for their biggest segment, especially with Game Pass breathing down their neck.
Okay, number 1 is gaming's future. What's 2?
Number 2, growth in music streaming and content monetization. Can they keep up their strong performance as streaming matures? Getting good returns on those expensive catalog acquisitions and managing their partnerships with Spotify, Apple Music, etc. is crucial.
Makes sense. And the third high importance factor.
Number 3, expansion into new markets in imaging and sensing solutions. How well can they actually diversify beyond smartphones into areas like automotive and industrial? Staying ahead technologically in sensors while fighting off competitors is key for this cornerstone business.
So gaming, music streaming, and sensor diversification, those are the big three. What else should people keep an eye on, maybe with medium importance?
Yeah, there are several medium importance factors too. Things like the overall global economy, inflation, interest rates, how that affects spending on games and high-end electronics. Also, the hit-or-miss nature of movies and anime in the picture segment. Sony's execution on specific big projects, like their first-party games, including the now-delayed marathon delays or quality issues, can really hurt targets. And of course, currency fluctuations, especially the yen's strength. Plus, things like trade tariffs and general geopolitical risks that can mess with supply chains and costs for their hardware businesses.
It's definitely a lot to track. Sony is clearly a company with so many moving parts, each facing its own set of opportunities and challenges. Keeping those key factors in mind really helps give you a deeper understanding of where they might be heading. Wow, what a deep dive that was. From mapping out all those business segments and looking at the intense competition, to understanding their growth plans and the really fascinating dynamics in gaming. Sony truly is the definition of a complex, modern global conglomerate.
They've definitely shown resilience and an ability to pivot strategically. But you're right, the ultimate test is whether they can consistently execute across so many diverse, high-pressure, and often capital-hungry businesses. It's a massive undertaking.
So, for you listening, the question maybe isn't just what Sony is doing day to day, but how a decision in one area, like that game delay, or a new partnership in anime, might ripple through their whole ecosystem. As you think about Sony's journey from here, what aspect of their incredibly diverse portfolio do you think will be the most surprising driver of their future success? Or maybe, what do you see as potentially their biggest hidden hurdle? Something to mull over. Thank you so much for joining us for this deep dive into Sony Group Corporation. We really hope you feel incredibly well informed and maybe see some connections you didn't see before.